Hi everyone. Thank you for making it to almost the end of day 2. And hi, Jaidev. So I'm here with Jaidev Janardana from Zopa. So today's session is about the rise of the Centaur. So I hadn't come across this term before, but it's defined as a business that makes at least $100 million in annual recurring revenue. But I guess the flip side of that is, the potential death of the unicorn, or at least, the unicorn as the kind of be-all and end-all ideal in fintech. So I guess, this session is all about sustainable growth and profitability and how that's come back to the forefront of investors and founders' minds. So yeah, I mean, Jaidev, I feel like you're the perfect guest to talk about this because you've just announced that you've broken even. So do you want to start by telling us a little bit about you and Zopa and how you achieved that milestone?
Sure. With Zopa, I'm CEO at Zopa. Zopa is a UK digital bank. We started our journey as a bank in 2020, middle of 2020. And we were really focused on meeting the borrowing and savings needs of the general people in the UK. That was very different from a lot of the other neobanks, which actually started focusing on current accounts and what I would call the spending needs. And the reason we chose borrowings and savings was twofold. From a customer standpoint, the choices you make around how you borrow, where you borrow from, how you save, that can actually save you or cost you hundreds, sometimes thousands of pounds every year. That becomes even more relevant in today's environment where there is a cost of living crisis on. Banks are not passing on some of the higher interest rates to the savers and so on. So our proposition, which was really focused around responsibly priced credit, fairly priced credit, as well as kind of competitive and honest returns to savers, really actually kind of rung true. So from a customer standpoint, clearly we thought there was kind of greater benefit in starting with focused on borrowings and savings. But more importantly, I mean, everybody who's been in financial services long enough knows that ultimately in banking you make money by lending. Net interest margin is your biggest source of profit. And our business model was really, in that sense, staying true to the traditions of banking. Of course, we were doing it very differently. We were using AI to make our credit decisions so that customers had speed and certainty. We were using customer insight and innovations to create more flexibility in savings. So while the products were offered in a very digital fashion, the core idea of making money through net interest margin was always there. And that meant that, from launching the bank in the midst of the pandemic, June 2020, despite some very tough times through the cost of living crisis, within 3.5 years, we were able to get to profitability very soon. And from that standpoint, I was never that interested in mythical animals, be that a unicorn or a centaur or whatever next thing that comes about. I think what matters is a business model where customers are willing to pay you more than it takes for you to produce.
Yeah. And I guess, you've reached this milestone at a time when it's, more important than ever to be lean and to think about sustainable growth and things like that. So, how are you thinking about this time and the kind of recent market turmoil? Would you say it's a worse time now to be a fintech than it was in 2021, for instance?
Yes, definitely, right? So the free money that was out there is not there anymore. So clearly, it's a harder time to be a fintech. But if I think about it from a perspective of what it means for the industry, what it means for customers, I think probably is better that this correction has happened. I do feel that some of the I think some of the correction probably has been overblown, and there is a sense of overreaction. But that sense, I think that was required because I think what was happening before was people were chasing number of customers and growth at all costs without the required concern around discipline around how do you make that business work on a long-term basis. And that meant, I think there was a lot of investment into business models that was never going to really fly. So I think that correction is probably good for the industry as a whole. It is harder to be here, but that does mean that for those of us who have actually almost made it to the other side, the opportunity is greater. I think we've proven those business models. I think in terms of fintech, that story has just started. when people ask about competition and competition among neobanks, I always remind people that no matter which product category you pick, typically more than 80% of market share still is with the big 4 or 5 banks. They haven't quite changed their way of doing business. So the opportunity is still very much there in front of us. And through the last few years, I think what has happened is a few players have emerged who have the scale, who have the discipline, and I think we can really actually go ahead and take share from the big incumbents and actually change banking for good.
And if you had to give advice to a founder today, starting a fintech company or a new bank, how would you advise that they bake in notions of profitability early on, and what have you learned from your own kind of experience?
I mean, I think at Zopa we've always thought about strong unit economics, and what does that mean? That means if you're going to make one loan, create one account, sell one unit of product, that net as a company, you're going to make more money out of that than it's going to cost to produce you, right? And that's very fundamental one-on-one on business. And that's would be my starting point for, entrepreneurs today is to, how do you think about your business model and make sure that you have that pretty well nailed down. If that is good, then of course, it'll take you some time to be profitable because you'll need a certain number of units for the fixed cost to be covered. But if that unit economics is fundamentally flawed, then it's very hard to kind of get out of that. So I think that would be the key thing to talk about. And I think another thing to probably watch out for today is, I think, a lot of fintechs today are in a good position when it comes to the unit economics. But when you look under the hood of that, what you see is that a lot of that unit economics have been supported, if you will, by the relatively high Bank of England interest rate that is there. So Bank of England, if you leave money with them today, give you 5.25%. Only about 2 years ago, that was about 10 basis points, right? So that 5% extra margin, some of them have been passed to the customers, but the rest is being kind of used to actually, I would say, prop up still questionable business models. Now, what that means is that I think the fintechs have now more time to figure out their business model, but I think we all know that this level of interest rate is not going to stay for a long time. And as rates start to fall, you will again start to see some compression for margin for some fintechs, and some fintechs kind of getting into trouble. So this might be a good time again to prepare for that, prepare for a falling rate environment, and make sure your business model can sustain a more normal level of interest rates, be that 3.5%, 3%, whatever that may be.
Mm-hmm. And I guess another thing that's changed in the new environment, so I mean, before the correction, it kind of felt like it was all about valuations, and I mean, we'd see it in the FT, all we wrote about was valuation rounds and reaching unicorn status and stuff. Do you think today we should kind of focus or talk about new metrics for success, and what would those be, and how would they impact valuations as well?
I mean, I think it's a good point that you raise about valuations, and I'd kind of blame you guys, the media, for it. The easiest way to get a story in the media is, I raised this much money at this much valuation, with very little actually diligence done on what is a preference tag that sits under it. Try to get a story that said, I made these many customers' lives better. Nobody writes that. Try to actually report a customer milestone. Nobody cares, right? But and today the next thing that is written about is, when will we IPO? And that's the next big obsession. I mean, I've been talking to journalists today for the last couple of hours. All I've been saying is that I'm not in a hurry to an IPO, but yet I'm sure the headlines that will appear tomorrow, as have appeared yesterday in your own esteemed newspaper, is Zopa thinking about IPO, right? So I do feel that if for this industry we have to kind of recover, we will require more responsible reporting, and reporting beyond valuations that actually can kind of think.
So what should we focus on?
I mean, there are so many things you can focus on. You can focus on customer satisfaction. You can focus on, what is the customer value that's being delivered. You can focus on actually profitability. You can focus on the level of governance, diversity. I mean, there's so many great things you can be covering on, which actually covers the health of the business. Valuations, particularly in a private context, is ultimately what one investor thinks about your company, right? It is not a consensus view. And sometimes, companies will go talk to 150, 200 investors to find that one person who thinks differently from those 150 and thus maximize their valuations. And if that becomes the center of coverage, then I think it produces an industry which will be kind of less robust.
Okay. And can you talk about Zopa again, and I guess what's next for you in 2024 and beyond, now that you've reached this milestone?
Yes, I think for us, getting to profitability was an incredibly important milestone, and thank you for covering that story. For us, it was a validation of the fact that the business model that we had created, customers are willing to pay for, and we can actually create a business that can pay for itself. But it also allows us to actually be more ambitious. As I said, we started off our life as a bank, focusing on kind of borrowings and savings for our customers, but our ambition has always been wider than that. We want to be the home of money for our customers. So our next big launch that we want to do is really actually getting into current accounts. We feel that as a business, where we are kind of ready for that. So expect us to launch current accounts back end of this year to our existing customers. Again, continuing to kind of widen the product set that we have in front of our customers. So I think that is a kind of a big next launch that we are planning for this year.
Okay. And is there anything you want to add before we go about anything you'd like to see in the ecosystem over, I guess, the next 10 years, given that it's the 10 years of...
Yes. I mean, I think I was talking to someone earlier about how long would it take for one of us to kind of displace the big four of the five. And I think if you think about it in the 10 to 15-year horizon, I'm very confident that one of the new banks that are there today, or a couple of them combined together, are going to displace, if not one, maybe two of those big four or fives. And I think for us to actually get there, I think, of course, there's a lot of responsibility on us as founders, investors, to make sure that we stay disciplined and continue to deliver good customer value, because that's what will get there. But we also need a stronger ecosystem. We need public markets which are kind of more receptive to higher growth and actually value growth as much as they value profitability. We need a media that actually supports and champions good UK success stories, rather than, when I look at the media coverage that I see in the US versus the UK, I do feel that somewhere in the US, success is celebrated far more openly and far more encouraging. It's encouraged a lot more. So I think we need a bit more of that. And we need to continued support, which I'm confident we will get from the government, to make sure that, the regulation that is there is appropriate and is all-encompassing.
I agree with you that the media is more negative here, but I think it's also cultural, because we obviously kind of, hear that from you guys, from the industry, and then we don't just make up sentiment. But thank you for a great chat and for the feedback. And yeah, thanks everyone for listening.
Thank you.